Look, if you're managing institutional capital or running a sophisticated trading desk, you already know the truth. Surface-level data, it's just not enough to generate a reliable edge anymore. So today, we're taking a journey past basic charts and into the real mechanics of crypto forecasting. We're going to examine the hidden engine that actually drives price action and explore exactly how the most advanced models out there are adapting.
Have you ever looked at a perfectly formed candlestick pattern, say a classic bullish engulfing candle, taken the trade, and then just watched it instantly collapse? It's frustrating, right? Why do two identical charts with the exact same patterns so often trade completely differently? Well, the answer is that the exact same candlestick can lead to massive profits or total ruin depending on hidden factors that never actually render on your screen.
Think of traditional OHLCV, open, high, low, close, and volume, kind of like a quarterly earnings summary. It's a highly compressed, lossy snapshot. Sure, it tells you the final result, but it tells you absolutely nothing about the day-to-day operations. To truly understand the market, you need the raw transaction logs. And in crypto, those logs are market microstructure and order flow.
So what exactly is market microstructure? Let's just define it clearly right off the bat. It is the plumbing behind price moves. We're talking specifically about order flow, bid-ask spreads, and liquidity depth. See, price doesn't move just because a pattern formed. It moves because of physical supply and demand imbalances. This plumbing dictates exactly where the price is physically allowed to travel.
Okay, let's really dive into this. Relying solely on candles is structurally incomplete for short-horizon forecasting. By compressing thousands of individual trades into just 5 numbers, OHLCV literally erases the actual causal drivers of price. A candle doesn't tell you if a price move was the result of steady, persistent buying or just a sudden sweep of a completely empty order book. Two identical bars can literally be printed by entirely opposite structural forces.
Let's look at a real-world stress test. Part 1. The October 10 Cascade, or what happens when the plumbing actually fails. Just look at this number, $19.13 billion. That is the total amount of capital liquidated across the market over a single 24-hour window. Absolute total devastation. And the crazy thing is, if you were only watching the price candles leading up to this, you would have been completely blindsided.
Because underneath the surface, the bid-ask spreads violently ripped apart. We saw a 1,321 times spread expansion. Order book depth simply vanished. The market was functionally empty.
And because that liquidity disappeared, the cascade was instantaneous. $3.21 billion evaporated in exactly 1 minute at 21:15 UTC. Poof, gone. That is the terrifying reality of a liquidity drought.
Now here's the kicker. The candlestick chart looked perfectly normal, completely calm, right up until the cascade actually triggered. But the real danger had been brewing in the hidden microstructure data for weeks. Perpetual funding rates had climbed from 10% to roughly 30% annualized. Open interest was incredibly stretched, and top-of-book depth had silently collapsed by 98%. The warning signs were screaming, but they simply weren't visible on the chart.
Furthermore, Kaiko research data reveals that crypto liquidity is incredibly concentrated and, honestly, quite fragile. Binance alone accounts for nearly a third of global market depth. What that means is a liquidity drought on a single major venue can aggressively drag down the entire global market. Context here is completely indispensable. You absolutely cannot look at a single asset's price in a vacuum. All right, shifting gears, part 2, volatility regimes. And this is all about understanding the broader market environment. This perfectly explains why your technical indicators sometimes just seem to suddenly stop working. The reliability of indicators completely shifts depending on the market regime. For instance, a classic RSI signal behaves one way during a low volatility maturation regime, where realized volatility drops below 50%, and a totally different way in a highly volatile toxic regime. This is exactly why static, rigid rules fail. When the underlying volatility fundamentally changes, the meaning of the indicator changes right along with it.
And this brilliantly illustrates that point. Academic research on Markov regime switching models proves that indicators don't just fail randomly, they fail because the underlying regime shifted. In different volatility states, the correlation and the jump behavior of these assets changes sharply. Ignoring these shifting correlations is, without a doubt, the fatal flaw of most static chart strategies.
So what data should we actually be looking at? Well, it entirely depends on your time horizon. What matters for the next 15 minutes is totally different from what matters over the next 8 hours. As you can see here, if you're forecasting short-term, you really need order book imbalance and spreads. But as you zoom out to 4 or 8 hours, on-chain flows and realized values start to dominate. And for daily forecasts, macroeconomic indices take over. A multi-horizon approach absolutely requires a multi-dimensional feature set.
Which brings us to the intelligence layer. Part 3, Explainable AI and Building C-Suite Trust. To process all this complex data, we need Explainable AI, or XAI. But let's be clear, in the institutional world, AI has to be strictly framed as a tool for clear decision support. Recent findings from an ACM computing survey consistently highlight that opacity, not accuracy, is actually the primary barrier to safely using AI in financial markets. Think about it. If an algorithm discovers a statistical pattern but cannot explain to a portfolio manager why that pattern exists, it creates an unacceptable compounding risk for institutional capital. It's impossible to audit and therefore impossible to trust during a drawdown.
So, the crucial point is this. A black box signal just spits out an arrow, up, 68% confidence. You can't interrogate it. There's no why. But an explainable forecast gives you the causal drivers. Bullish, but specifically driven by a 20% stablecoin influx and widening spreads. Identifying these specific drivers is exactly what bridges the gap between impossibly complex data and actual user trust.
Explainable AI empowers decision makers by extracting the why behind the what. It exposes the order flow, identifies the regime drivers, and importantly, it flags when we're in a low-confidence, widespread environment where trading should probably just be halted. And most importantly, it maintains the human-in-the-loop safeguard. And AI's job isn't to be some magic oracle, it's a context extractor that gives the sophisticated trader ultimate situational awareness before deploying a single dollar of capital.
I really want to leave you with this final thought. A forecast shouldn't be a command, it should be a briefing. Your true forecasting edge doesn't lie in blindly following algorithmic signals. It lies in understanding the hidden market mechanics, mastering the plumbing, and utilizing transparent AI to synthesize context faster than the competition. So you have to ask yourself, are you trading the actual market, or are you just trading its shadow?